There is the common saying that nothing is as certain as death and taxes. It's a phrase which emphasizes that death and the payment of taxes are both certain outcomes that everyone will experience. But in this video, I won't focus on death, but taxes. Because you can be sure to receive in the post that little love letter about paying the taxman if you are an income earner. I'm pleased to see you here. My name is Funke Ogunjobi. I'm a qualified accountant with over 2 decades of experience, especially in the finance sector. Here on this channel, I discuss money and all money matters, how to earn money, how to manage it, and how to keep more of it legally. Because financial knowledge is power. So I'm doing this video for you and I'm so excited to put all of this together. And I would like you at the end of this video to really subscribe, like and share, because it's taking a lot of time and effort to pull all of this together. Just because you asked for it, I'm not having to give it to you. Because in this video, I'll be breaking down UK income tax, how the rates work, and how your earnings, whatever it is that you earn, are taxed at different levels. I'll walk you through real life examples. I'm going to compare, examples with and without pension contributions, with and without national insurance deductions, so that you can see exactly how to maximize tax relief and also reduce your bill at the end of the tax year. There are many different tax bands used in the UK, a lot of them. And I would just like you to note that your tax rate depends on the total income, which includes your salary, that is from your 9-to-5 job. If you earn pension or you're already drawing from your pension, you'll be taxed on that. Dividends, if you receive dividends as a business director or a shareholder. Savings interest and investment gains. So for example, you have stocks and shares or any other asset that you earn interest from. All of these will be taxed, by the government because they are all earnings onto you. But just to simplify it, I'm only going to use employment income on this video, and that is your salary from your 9-to-5 job. Please note that other earnings, you will have to make the government aware because they're going to tax these other earnings, and the first thing they do is they assess it and then they now apply the different tax bands on that and then give you a bill to pay at the end of the day. And all of this you can do via your self-assessment return at the end of the financial year. Again, I'm going to focus just on employment income, which is the salary you earn from your 9-to-5 job. So by the end of this video, you will know exactly how your earnings impact your tax and how to legally keep more of your hard-earned money. Let's dive in. The income tax rate for England, Wales and Northern Ireland is set at 4 layers. That is your personal allowance, which is set at 0%. Your earnings must be between 0 and 12,570. As long as you're within that earnings bracket, you're not going to pay any tax at all. And this is considered the best salary that anybody in the United Kingdom can earn, because this is the salary that you don't have to pay tax on. You owe the taxman no dime in tax payment. And the next one to that is the basic rate. The basic rate is having the earnings between 12,571 up until 50,270 pounds. So once you are in this earning bracket, you have 20% as the maximum tax that you can pay. Note here that you only pay income tax on the portion of your income that exceeds the personal allowance. It is not the totality of your earning that will be taxed at 20%. Please note that. And after that, you have the higher rate, so which is anything above 50,270. As long as you are just above that limit, even if it is £1 by which you are in excess, that £1 will be charged 40%, meaning that the government is going to keep 40p and you will take 60p home. So another thing is you want to look at that particular bracket and make sure that you don't have a lot, that falls in between that bracket. You don't want it. And the next one is the additional rate, and that is where you earn above 125,140 pounds. Anything above this threshold will be charged at 45%. Again, you want to make sure that you don't want any of your income to be in that bracket. That is why you have to understand other things that you can do or other places that you can actually stash your money that are tax deductible, and you will not have to pay taxes, in those other places. There's something you want to do. You just want to guard jealously that particular bracket. You don't want most of your earnings or any at all to fall within this threshold. So because you'll be charged 45%. For example, if you have £10,000 of your earnings, come within this threshold, it means you're going to go home with £5,500, and the government is going to pocket nicely £4,500. You don't want that. And that is why you have to understand other things that you can do legally, to keep more money for yourself than giving it away as tax. And now we move to Scotland. In Scotland, there are 7 layers of tax bands. The first one, like other parts outside of Scotland, is set at 0%, which is the personal allowance. That is for everybody who works and who is an employee and earns income in the United Kingdom. So as long as your salary or your earning is just below £12,570, you pay 0 tax. Scotland has got the starter rate, which is set at 19%, and for that tax or earnings bracket. Also, after that is the basic rate, which is between 15,398 to 27,491 / 20% on that extra bit, and that is what you pay the government at that tax year. And then you have the intermediate rate, which is anything above the basic rate up to £43,662 in any tax year. 21% tax is taken from that amount. The higher rate, which is anything above the intermediate rate, up to £75,000 per annum. A whole lot of 42% is going to be charged against that earning, and that is what you pay at the end of the year. Again, I will say this: you don't want your salary or any part of your earning to fall into this 42% bracket. So you open your eyes and look at ways by which you can move your money, into other tax deductible accounts so that you don't get to this higher rate at all. After the higher rate, you have the advanced rate, and that is anything above the higher rate up to £125,140. You pay 45% on that excess or that extra. Again, like I said, for the 42%, you want to make sure that you work out your earnings so that you have a 0 sitting in this tax bracket. You don't want anything taxed at all at 45%. That is nearly 50% of your earning that the government is going to take at that particular bracket. And then, quite interesting, Scotland has got the top rate, which is anything above the £125,140. That is almost 50% that the government is going to take, meaning that they're going to just divide your money into 2. They take half as tax, and then you keep what is left. Again, you have to make sure that you work out your salary on paper and know when exactly to move some money away into other tax deductible accounts. That's going to save you from giving 50% of your hard-earned income to the government. And you can do that using different methods, especially you're putting more money in your pension and also putting more money into your ISA account. For those who have their kids, you can actually take part of this money to pay into their ISA account as well, so that you try as much as possible to avoid the 42, 45 and the 48% thresholds. You don't want a dime of your money to fall into this bracket. So in the first example, I'm going to consider 2 taxpayers, Mr. Olatunde, who lives in Scotland, and Mr. Nwosu, who lives in England, each earning £14,570 per year, which is £2,000 above the tax-free personal allowance. So we're going to see how much income tax and NI each one will be paying at the end of the tax year. So looking at the table, total income the same for both taxpayers, personal allowance the same across the United Kingdom. So the taxable income, that is the excess over the personal allowance, for the 2 taxpayers is £2,000. But this is where it starts to get different. The income tax rate applied to each taxpayer is different because of where they reside in the United Kingdom. So the guy who lives in Scotland is going to pay at 19%, while the guy who lives in England is going to be charged 20%. So the income tax due is 380 for the Scottish man and 400 for the Englishman. And the NI threshold over the personal allowance is 0, but they now start paying NI from the excess over the personal allowance. And in this case, for the two of them is £2,000. And 8% applied to that will give you the same amount of NI due for the two men, which is £160, £160. The total deductions for the Scottish man is 540 and for the English taxpayer is 560. So just a slight difference because of the small difference in the tax rates that had been applied. And you see that the monthly pay is just £2 more than the other one. So in this example, we can see how tax rates are applied depending on the region that you reside in, and also the impact of tax rates on the same income, but for people living in different geographical regions in the United Kingdom. The English taxpayer paid £20 more in tax than the guy who lives in Scotland, and this is due to the slightly lower income tax rate that had been applied in Scotland. So that is one example, and we move on to the second one. Example, again, we are using those two men, and the average salary that is quite common in the UK is what I've chosen to use for the two of them. So that's the average UK gross salary, which is £37,430. And at this point, you will see that on the table that the personal allowance has been taken out for the two of them. So, and this time around, I'm not going to consider any pension contributions. It's just that I want to make it straightforward so that you can see especially how the income tax rates are applied to salary. That is just the point I want us to understand here. And also to help you, personally, when you look at your payslip next time, to understand how the different rates, have been applied to your salary, just in case you have any query. You understand, from there, that's okay. That is actually the amount you should have paid. The personal allowance for everybody in the United Kingdom is 0, so it's not going to get taxed at this amount. So, and if you see the Scottish income tax, I've actually put it here so that it's easier to see, and just to put everything on the same page. We see that the next rate to the personal allowance is the starter rate in Scotland, which is the 19%. And the threshold for that is 12,571 to 15,397. And I've just written that out here. So, and I've written it as the low and the high end so that it's easier for you to understand. So the low end is this one here, the 12,000, which is here. And the high end for this threshold, this 20% threshold, is 15%. Is 15,397. So, and what you then do is, you now see 15,000 less the low end. So that's the high end less the low end. So that is what we give you, the threshold in terms of the earning that we're looking out for in this 19% band. And the amount here is £2,826. So that means of Mr. Olatunde's salary, £2,826 will be assessed, at 19%. So, and you have the tax payable as £556. If you come back here, you'll see that it's the same amount. So I go to the next one, which is the basic rate, and that is 20%. Again, I split out the low and the high end. And so I say £27,000 minus 15,000 plus, and that will give you 12,000 this amount. And then you apply the 20%, which is the rate for that threshold. And so its tax payable is now £2,418. You do the same for the intermediate rate, which is at 21%. But this is where you have to be careful. You see that the low end for this is 27,000, which is what I've got here. But the high end is 43,000, which is way more than what he earns, in a year. What he earns in a year is 37,430. And so here, instead of putting the 43,662, I won't do that because the salary is not up to that. So we don't want to charge him more than, it should be charged in the year. And that's the point to note. So I'll just come back here and put the high end, or that is the highest salary that, is earning for that financial year, which is 37,430. So I put that there. So that means that the earning that we'll be looking at here to apply the tax rate on is 9,938. So 21% applied, and we have that tax payable for him at that threshold. So what you then do is you total all the earnings that you have here, and the total output is 24,857, and you check that with the taxable income. It must be the same. But due to rounding, differences, I'm £3 short. But that's okay. You don't have to worry about that. So this and this tie. So meaning that we have not taxed him more than he ought to be taxed, at the end of the year. And then you come and look at his tax payable. And this is 5,042 pounds here. And I'm just going to check that with the figure I've got here, and which is the same. I'll say at this point that the figures on the table I've actually gotten from using the HMRC income tax calculator. So it's good now that we've got, our numbers from two different sources, so we can compare and say that, they actually tie in. So meaning that the amount that the HMRC had actually calculated is the right amount based on my, manual calculation that you can see on the screen. So, and you can see that for Olatunde, I've given it a code, a color code, and also so that, it's easier for you to spot the numbers. And that is how, you calculate your income tax based on, the different thresholds, that you have in the financial year. Now I go to the guy who lives in England, Mr. Ongusu. And so we start looking at, the different tax rates that they've got in England. And the next one that he should be assessed at is the basic rate, which is 20%, and the low end is 12,571, which I've got here. And the high end is 50,000 plus. And again, similar to what happened to Mr. Olatunde, he is not earning up to £50,000. So we won't put all of that under the high end column. No, because then you'll be charging him more than is meant to pay in the year. So what you then do, like we did previously, we bring the whole of this gross income into this high end, and then we do our takeaway. So that is 37,430 minus this, and we have that one. So going back to what I said earlier, you want to make sure that the figure here is the taxable income. You don't want it to be more than that, so that it's not paying unnecessary tax. And you can see it's just £1 different, which is okay. And then you apply this 20%, and then it's got this tax payable at this amount. So this is how you apply the different tax rates, to your salary. And I think with this example, you'll be able to look at your payslip going forward and be able to work out, this for yourself, or even help anybody that that is going through, one thing or the, or anybody that do not understand how to work out, these different tax rates on their earnings. If you have any questions at all, just drop that in the comment section, and I will get back to you as soon as I can. So this is the third example, and this one is called the pension contributions, unlike the second one that we just looked at. So let's go over this and see what is actually the difference between this example and the previous one that had no pensions. Now again, the same salary for the two of them, and this is Mr. Nwosu. I was going to add his name quickly. Mr. Nwosu there, and that's the man that lives in England. That's the man that lives in England. And so the same salary like the previous one, and now we've taken out again the personal allowance. So here we have the pension contribution. So the 8% has been applied. So that's 3% from the employer and 5% from the employee, that is the taxpayers themselves. And you can see here, unlike the other one, the taxable income has dropped just because we had taken out their pensions, before applying taxes to their taxable income. So again, based on, the previous explanation, I had just split out, the thresholds for the tax bands based on low and high end. And I did that for the 20% rate as well. So that's the 15,398 here and the 27,491 all there. So the difference is what we have here, and for that one, that is the difference. So when you get to the intermediate rate here, this is where you have to just be careful and ensure that you plug in the numbers correctly so that you don't underpay, under-calculate for your tax or over-calculate for your tax. So again, the low end is 27,492, which is what I got there. And then 43 is the high end, which is not what this guy is earning less than that. So I go again, put is, gross income here. And here you have to include your pension, because your pension must be taken or deducted from, your salary before you apply your tax. So what I've done here is I've said in this box, so the formula there is 37430 minus 27492 minus the pension. So that gave me 6944. And then on that, the 21% was applied, and we had that reduced, tax payable at that threshold. So you come back here, you add all of these earnings together, and you have 21,863. You come back here and check that to be sure that the taxable income is not different from what you had actually used to calculate its tax. In the end, you see that it's about similar, so rounding differences again that I've noticed. And come back here and look at the tax payable. Are they close? Yes, they are. So that is good. And also remember, this is manual calculation, and this one I got from the HMRC calculator, which is online. Again, the link is in the description. And so that is for him. We do the same for Mr. Ngusu, who lives in England. Again, he is going to be assessed, using the basic rate, because that is where the salary, sits. So we do that, we take out his pension as well. So that is 37,430 minus this one, minus that one. We get this 21,865. You go back and check, yes, this one ties into that. And apply 20%, which is the tax band for that threshold. The tax that is going to pay is £4,373. So let's go back here and check. Yes, not too different. So that's okay. And we're now fine with the figures. So you can see that the monthly pay, where pensions had been taken out, is different from the monthly pay where you haven't got your pensions taken out. So let's just look at the difference quickly. So without pension, so what did he have? So this guy has got this amount, and this other person has got that. So let's say, what's the difference between when pension was applied and when pension was not applied? So that is just that difference. So meaning that when pension was applied, Mr. Olatunde was earning or taking home £197 less than what he would have at if pension was not deducted. And the same thing with the man in England is taking home £199 less than what he would have normally. Well, that is just for that. So if you look at the pension that was taken out, for the year, you would see that it seems to be a lot, but let's divide that, by 12 and see how much exactly he has saved, for his future self at the end of the year. So meaning that, each month he had saved 249, let's say £250, towards his future self. And that is a lot. This money in the previous calculation was taken up by tax. He didn't, put anything towards his pension, meaning that he was paying his future away as tax to the government. But now that he's decided to, include pension into his earnings, he's only just going to have £200 less. You can see here that it's worth it, really. to always, include your pensions in your salaries, because by that you're able to reduce your tax payable at the end of the day. And that is one measure, that a lot of people use to reduce the tax payable on their salaries. If you are a self-employed person, you have up to £60,000 that you can take out from your earnings as pension, before you actually apply your tax rate to calculate your tax payable at the end of the year. So that's one thing that I would just like you to consider. But for those who are employed, you can only increase the amount of pension that you want to put in your private pension. So that means you have to increase the percentage. If you're not earning up to 60,000, there's no way you can get 60,000 put into your pension, your private pension, if you are employed. For somebody who is self-employed, this is, something that you can do. If you have up to £60,000, that you can actually, put away and save into your pension pot. Why not? As long as you do that, you're fine with the law. You're not going to get queried and you're not going to get penalized for doing that. So again, if anybody has got any question, please can you just drop that in the comment section and I would get back to you as soon as I can. And I hope with this 3 examples, you now have that confidence. Anytime you see your payslip, you can punch the calculator and you can, look at the figures and say, yeah, this is right. No, this is wrong. And, and do, whatever is needful at that point.